Hi, this is Randy Finney with Right Side of the Chart, and this is a mid to latest session update for Monday, September 23rd, 2024. It's 2:46 p.m. Eastern Time. I'm starting the video, and here's what we're going to do, and I'll try to keep it in this order if you want to skip ahead to anything. We're going to cover do an update on the major stock indexes. I'll start there. Segue over to the financials, starting out with the regional banks, then the big banks. So I'll start with KRE, XLF, then let's talk about the semis just briefly, including Intel and NVDA. Then I'll roll into commodities. I'll hit on a couple things there to watch and updates on some of those trades that we have. Treasury bonds, and then just any miscellaneous trade ideas that I've highlighted recently. So, all right, there's a lot to cover, but I'll go through pretty quickly here. As far as the market, I'm going to get to this in just a second here when I cover the indexes. There's not a lot. Remember, we're on that kind of blackout period. Earnings season still coming up. I haven't started really officially yet, so the only thing you really have to watch for that you know it's coming. Of course, I'm not talking about any random events that can hit the market, but those that will watch is the economic calendar. Consumer confidence we have tomorrow, but that's really, to me, that's a coincidental indicator with no predictive value. It goes up and down with the stock and housing market, home prices, and especially the stock market going up. Consumer confidence typically goes up, and again, it's not a big one. This is really where things get interesting come Thursday. You can see here we have durable goods, GDP, and jobless claims. Big trio, big potential market movers. So where I'm going is, if this breakout's going to stick or fail, will most likely be, it could be determined before then. I'm going to get to that again in a second. I still favor it failing, and that's if there's going to be an inflection point where things start to move. It's and it can go the other way. This could be an inflection point, or at least an acceleration of the rally or the breakout. I'm going to get to that again. We've stalled out since breaking out on Thursday. But those are the big ones to watch. And Powell's going to flap his jaw as well at 9:20 in the morning. So the report's come an hour before the market opens, 8:30. And then 10 minutes before the market opens, Powell's going to start talking. And that has the potential always to move the market. So there's your kind of what to watch for from on the macro on the calendar this week. Now let's dive into the charts here. So to kind of recap what happened, we had these primary downtrend lines off the highs recently in just about everything. We had them on all the indexes, the big ones that I follow, the QQQ or the NASDAQ 100, both the futures and the ETFs, as well as SPY, ES, IWM, and the RTY small cap futures. All had them. Even the semiconductor sector had a identical downtrend line off the highs, very clean, recently broke out. So remember what happened last week is we were kind of moving around there. We had a few intra-period breaks, but no official breakout. So it really wasn't even you can call it a whipsaw, slight move above there. And then the Fed meeting, initial reaction popped up, and then they faded it and closed it down. And then the following day, once the Fed meeting was out of the way, we closed there, we gapped up and clearly broke out above the trend line. So as I like to say and have said, a breakout is a breakout unless it fails. So that's the breakout. They did fade about half of it on Friday, but again, we're right there right now. So we have not built on that gain. The gain was 100% technically induced. It's funny, you even listen to the folks in the media come out, and the headlines I read, trying to attribute, they said, Wall Street didn't like initially the 50 basis point cut because we closed down that day. And then the next day they all suddenly loved it. Again, this is just pre and post FOMC noise. There was the market's decision after they had time to digest everything as a net positive. However, they haven't built on the gain. Now, the breakout, it hasn't failed. And so as I continue to say, unless breakout fails, it's going to be taken, you have to take it on face value. It's bullish. But that's the big thing. So the levels to watch going forward on the bull side is this right here. Bullish if we can take out that to 485, 70-ish level. Remember, that was a previous reaction high. We have a big gap here, the bottom of this big gap. We have major reaction highs here. And this whole thing, which proved to be, that was the top. I'm trying to box it in. Let me grab my tool. That whole breakout there, that was all-time high. Bearish engulfing candle. So it was a mountain of technical evidence that I'm still going off of that marked, quite likely marked a major top. However, that starts to get threatened here. Remember, this is, let me just zoom in a little bit. This is that kind of that area that I've been referring to as the escape velocity, kind of where you get close enough to the highs in the NASDAQ 100 here, which again to me is the most important index right now because it's just that concentrated view of the Mag 7, the big stocks that matter the most. And so if you get in there, that's where, you know, you have the top of the gap right there, and it's just thin air. The previous high is right there, so you're most likely going to pop it if that happens. So these are levels to watch. A solid break above, really it's Friday's highs right there. We'll call that 486. Going to be near-term bullish and increase the odds that you may want to go on to backfill this gap. That's also going to increase the odds that you're going to run at the highs. But unless that happens, this is resistance. So that's kind of the story. So resistance right there, call it 486. And for the breakout to fail, which would be a very bearish technical event in my opinion, we have to then go down and break down back below solidly, especially close back below the downtrend line off the highs. You also have the uptrend line off the lows. It gives us this symmetrical triangle pattern right here. And so obviously a break below that as well would be bearish. And then this is kind of the lights out number. Again, first things first. The breakout's intact. The breakout has to fail. Then we need to take out the uptrend line. But about 448.72, again, it's this reaction low from right here, September, what is that, the 8th, I think, or somewhere around there. That isn't the last stand. The last stand is the August 5th lows. But if, again, I've stated many times over, I think if that level goes there, we'll start to go on down, and just a break of the 448.72 in my opinion is going to increase the odds substantially that August 5th major reaction low will get taken out. So those are your levels to watch. Bullish here, even more bullish above. It's roughly about 495, and obviously then that's new highs. We'll talk on that if and when that happens, and then bearish if we fail to break out here. So on SPY, the S&P 500. You've got the same, similar. It's a little bit different. Your highs are roughly equal, about 564 or 5 right there. It's a slightly downward sloping trend line that was taken out on Thursday as well. Put in a divergent high. We had divergence already forming, and that new high there was still divergent high. Divergence, I always say, whether it's bullish or bearish divergence, this is bearish or negative divergence. It is not a sell signal. It's merely an indication that a trend change is likely, and that's why I favor these breakouts to fail, among other things. But so I'm looking for the S&P 500 to fall back below. Again, you have about 55.64, and then the downtrend line right there. So bears want to see that. Bulls don't want to see it. If you are bullish, you can buy any backtest to the trend lines on QQQ, SPY, or the futures, or any of those, and set a stop somewhat below. I'll also add that it's not unusual to see a backtest slightly get undercut the key level. The powers that be like to do that, and then they sniff out some of the stops that are placed right there, only to reverse it. So it's not a complete binary thing where the rates go from 0 right now on the bear side to 100%, and they don't flip around like that. It's incremental. So if you break down below, if the breakouts fail on both the S&P 500 and the NASDAQ 100, meaning we go back below those trend lines on both, the odds have now shot up. In my opinion, substantially over 50% that these breakouts will fail and fail permanently. However, it goes up incrementally from there. So in other words, the farther you get away from there, in each of these support levels below that you can see on the chart, if they get taken out, that increases the odds. So that's kind of the overview. And we've just been kind of, like I said, drifting around aimlessly. It was a one-day wonder, again, a technically induced pop that followed the fundamental decision, the rate cut by the Fed, which again was already priced into the market. So so far, not a lot of buyers behind it, but it hasn't failed. So we'll call that just a no change from last week, really. All right. The other ones, like I said, small caps. I'll cover that too. IWM, you also had a nice clean downtrend line off the highs right there, well defined, post Fed breakout. It also put in a divergent high, and that also increases the odds that this breakout will fail. Just like these last two divergent highs, you saw selling follow, just like you saw after this divergent low rally. This is it, divergent low right here, rally. This is swing trading right here, right? And so, but bigger picture, again, if the breakout fails, that's going to be an extra bearish technical event. Otherwise, there's the previous highs that they popped that. They're probably going to have taken the divergence out. Why? Because these indicators will have moved up. You get these indicators roll up here, and if you take out these previous highs, you no longer have negative divergence. So that's what to look for on the indexes. Let me roll into regional banks. So the small caps you can see are under pressure today. You can see just, a lot of a pretty good fade since last week's rally. So far dropping about 2.5%, just like the S&P. We faded about half of the pop, the post-Fed pop. But again, nothing big. We haven't faded the whole pop yet. What I've noticed today is regional banks are under pressure. And, rightfully so. I've highlighted this in the last few months on 3 different occasions, or a couple occasions each time. This has been, was back here, back in July, my shorting zone, objective short entry, anywhere in this yellow zone here. We went down, we hit, it was a double-digit drop down to that 50.48 target. That's when we covered all our shorts and went hard, hard long, including any shorts, including KRE. We had another shorting up there, fell down to that 53.17 target, bounced, and recently I recommended it or suggested it as an objective shorting up once again at the same level. Watch, rinse, repeat. Whether it plays out or not is going to depend if it can take out this uptrend line right here that comes off the June lows. And then, of course, the 53.17 support / target. These are your levels to watch. And then, obviously, that 50.48 that we hit before. And you can see them all here. And this is a really big one here, about 45.59. That's kind of lights out for the regional banks. If that happens, you're going to see things, it's carrying out to the rest of the market, in my opinion, especially the small caps. Remember, IWM has a pretty good weighting in these regional banks. And if it wants to push up a little higher, I can easily see that there. This is our divergence line right here. We had negative divergence there. Comes across higher highs in prices, right? Equal highs in the indicator. If we take that line across, any marginal new, as long as it's just marginal and slight, it's going to give us this big bearish rising wedge. So we'll watch that as well. So if they want to really push the upper limits of where, I can see this bounce, this market, current uptrend going, that would mesh with just a little more upside in SPY QQQ, but not much. Really QQQ is what I'm looking at. And then likewise, the levels to watch. So the way I do it, set price alerts. I watch these, I'm active, in front of my computer most of the time. I had to go out for something today, leave my desk in the morning. But there it is. Those are the levels to watch, and that'll increase the odds they're going down. And if there's problems with the regional banks, which so far, remember, this is Fed day back here. It was Wednesday. Thursday was the first full day. They rallied like everything else right there. One green day, and then boom, they've been coming under selling pressure. Why is that? If we're not heading into recession, we're getting the lower rates, stimulative, what's going on with the regional banks? Again, 2 days doesn't make a trend, but it's 2 pretty heavy days of selling so far. You can see red candles. And again, it's failed where, it's failed before. This is that resistance / shorting zone. Now let's roll into the big banks. So the regionals are your smaller banks. These are XLF. This is not BX. There is a BKX, the banking sector ETF, but you can also, and that's just more what is it? What I do? BKX? Yeah, BKX. So this is what the banking sector itself looks like. You've got all the big ones in here too. I believe this is big divergent high right there. In fact, it comes all the way back from here. This is all one big divergence. Has been building for quite some time. right there. You can take that line up there at resistance as well. So the banking sector is at a pretty key resistance level. I can tell you right now that's, objective to short there. If it pops that, what you want to see, what bulls want to see is the divergences get taken out, and then that resistance level. As of now, this chart looks bearish to me. It looks like they're going to fail here at resistance. It's objective to short. And let me go back to the XLF, which is more of this is the financial sector ETF. So not just banks, but you also have insurance companies and companies like Berkshire Hathaway and whatnot. So that's it. Big divergent high. Nothing's changed recently. JPM Morgan broke down. We had that sell signal there. Drop, double-digit drop. Hit my 203.47 support. Bounce there. That bear flag that I talked about a week or two ago has gotten too large in relation to the flagpole. So it's not really what I'd be considering a bear flag. But the lower uptrend line is still very much a clean trend line. Again, the flag's just a little too big proportionally to the flagpole to move down to it. However, a break of this minor trend line should open the door. And, of course, obviously a break of that 203.50-ish support. We had a little spike below there intraday. That will most likely set the next leg down, and JP Morgan take it to this next target here of 191.42-ish and the intersecting 200-day moving averages. So that would be a drop of about 9%, and it will almost certainly bring the entire financial sector down with it, one of the largest in the S&P 500. In fact, it's the second largest sector in the S&P 500. So, what's going on here? We got the 50 basis point rate cut, which has been spun as nothing but bullish for the market. Yet the banks, you can see since Wednesday, like everything, had a little one-day pop, not much. And there's no follow-through buying so far. So it's not a win for the bears, but it also is just kind of a little tell. Where are the buyers right now? Why aren't they buying up the banking sector? What's going on there? So like I said, JPM is kind of sucking wind, and watch those levels. It needs to break that trend line. Some of the other banks are still, Bank of America, you look at Wells Fargo. Here's Wells Fargo in a clear downtrend. Downtrend is defined as a security making lower highs and lower lows, and that's what you have here. So it's not the only one, but it's one of those. And others are pretty fresh off their all-time highs, like Berkshire right here. Big, massive sell signal. I highlighted this one on the breakdown there. Hit my first target zone right here. Bounced as expected. That's why I list multiple targets. Upon the initial tag of each one, a reaction's likely. And so we just need to break the bottom of that first target zone there, about 444. And then you've got the primary, that purple uptrend line is your primary uptrend line. All the better when that goes, and that's going to increase the odds we're going to hit these next targets right here. All right, but as I like to say, support is support until unless broken. So let's see what happens here. Those are the levels I'm watching on the financials. Let's roll into the semis, just a completely different sector. But one that also has a nice clean uptrend line in which to trigger a powerful sell signal if and when broken. Last time we hit it here, I highlighted it, and we hit it there on the August 5th lows when we covered all shorts, including this one, reversed, came to bounce, and just like the indexes, SPY, IWM, QQQ, we had a beautiful downtrend line in the SOXX semiconductor sector ETF here. That popped post-Fed on Thursday. The Friday, they faded a lot of that, but not all of it. We remain above it, so very, very important level. If this breakout fails, that would be the first bearish technical event, sell signal, objective, entry or add-on to a semis. And then more importantly, very, very importantly, if this trend line is clearly taken out, especially with a solid red daily close below it, then that is going to be bearish for the semis. Up until then, they are right now holding above. They've had two brief undercuts and successful tests of the 200-day moving averages, just like they did here. I think you can see them, the blue and red lines on here. They tend to, because there's a lot of velocity and momentum with their volatility in the semis, so they tend to pierce the 200s and then recover. So, but usually once you test them from above and a bull trend, it's off to the races. This time around we bounced, but it was relatively weak. But we also had dual support. You had the trend line as well. So again, if the trend line goes, you want to keep it very simple. Just replicate that trend line off the October low, set a price alert. And if that goes, and it goes with conviction, that should be lights out for the semis. Until then, all I can tell you is they're above primary uptrend line support, and as of last Thursday, they broke above the downtrend line. So that's where they're at. They're in that's near-term bullish price action. I suspect it will fail, but until it does, you just can't get too aggressively short the semis. On that, NVDA is the biggest component of SOXX, and as you know, we've been trading this one long, short for a while now. You had the primary uptrend line. We had the first short swing short entry was here. You were given 3 targets on the 60-minute chart. From that entry there, 1, 2, 3, we hit T3, the August 5th lows. We covered NVIDIA and all other short trades, went long. We also covered it here after shorting here, reshorted, covered there because you had positive divergence on the 60, and you also hit the primary uptrend line. And then most recently, this has been my reshorting zone, this purple box here I told you. My plan is to short up to, but not above the downtrend line. And I also would like to see, obviously, semiconductors fail and break their primary uptrend line as well, which will happen if and when NVIDIA breaks it. So remember, this is a 60-minute chart. This is the daily chart. This is a very, very important trend line that when broken will most likely take out this uptrend line in SOXX as well and take you down to the, remember, on NVIDIA, I'll give you long-term swing targets based on the weekly chart right here. And so we hit that first one there. We hit the uptrend lines, T1. So on the weekly chart, the next target's down there around 76. And that's going to be, if and when hit, a drop of about another 35%. This one's already fell from the highs into the lows where we covered it on the morning of August 5th. It fell 36%. And I'm not bearish on all semis. The only one I have and have had for a little while now. I've highlighted this one based on long-term support on the weekly chart. This is the weekly chart right here. There's that long-term support level, divergent low. And so I've highlighted it here a couple times recently. We're up on it so far about 20% gain on the trade. This is still the first and only official target. I gave you additional targets if we can get some traction, especially if the Qs break to new highs and the semis go up, then this one will most likely continue higher. We did break out on Friday. I highlighted it. And I didn't realize until today, somebody mentioned on Friday, we closed a hair below the 22 level. And so that breakout technically didn't finalize on Friday, but all day today we've traded back above and have held above 22. So the breakout is intact right now. That does increase the odds we'll go up here. T1 is set below these 2 reaction lows. We went long on that one there twice, and that was the last trade. We had long trades there, and then we gapped down below it here. So that's where the sellers will most likely step in first, and then if they can get through there, again, depends on what Intel and everything else looks like at the time, but right now that's still my preferred and sold target, just below the 2466 resistance level. A lot of eyes are going to be on those 2 reaction lows. That's why the sellers would be likely to step in early, and if we hit it, it's going to be a gain of about 30%. You can either book profits altogether or just set a stop if you think it's going to go up higher. Again, my preference is to get out and take the money and run. Alrighty. What else is there? Let's go into commodities real quick. We'll look at. We'll talk about the broad-based commodity ETF. I'm going to talk about. I'll get to DBA in a second. So DBC. So we have DBC and this is the one which was it? DJP. So I want to talk about DJP a little bit. So this is the Dow Jones, IPATH Dow Jones UBS Commodity Index. It's a broad-based commodity ETN technically. And as I mentioned, I've highlighted all these pullbacks to this 2932 support level, including this most recent one is objective long entries. And bigger picture, if you're just new catching up, this commodities as a whole peaked back here in 08. They've been in a bear trend that bottomed, and when the markets bottomed, when COVID hit, and and ended the bear market in March of 2020. This I'm viewing by every metric. It's not just, this isn't subjective stuff in my opinion. We took out the primary bull market downtrend line. We've taken out multiple previous reaction highs. So this has all the making of a first wave up in a new bull market with a first corrective wave. Just like you had a new bear market here, first corrective wave up, next primary wave down, corrective wave up, last wave down, and a 5-wave. So we'll see. I'm not predicting a 5-wave count rally. Who knows? We'll take it as it comes. Like I said, Elliott wave I kind of use loosely, but these are definitely waves there. And so what I wanted to update this one, not only is it doing well, look at the explosive. Remember before just about a week before the Fed FOMC meeting last Wednesday, the odds started shifting away from favoring a 25 basis point cut, which was all along up until recently, to 50. And so this is the return. If you guys remember, I don't have it queued up, but over 2 years ago, when this whole runaway inflation thing started, I made a little diagram of a negative feedback loop. It's like a vicious cycle between interest rates, the stock market, and then commodity prices. So what happens when rates go down? Stocks will rally based on lower rates, but then you get the commodity trade and commodity prices start going up, and then that brings back inflation. So you're not going to hear about it for a little while. There's a lag, but I usually get in front of this. This is where, like I said, Powell has now returned back to his natural ways. I call him the scorpion, from the scorpion the frog. He's a dove by nature. We all know that, as was his predecessor and her predecessor before her, Yellen and then Bernanke. They're just what they have been. And so what you're seeing, where I'm going with that is, you can see as soon as the odds started shifting to 50 basis points, commodities have gone vertical. And this is, again, it's gonna be what I'll call the bane of Powell. He's gonna, sooner than later. Again, this is gonna have to do a little bit more till the market really starts taking note. We're still, not too far off the recent lows. But if you recall, for years now, I've used DJP. I've done these boxes here, right? And with almost impunity, predicted where, if the CPI would come in at expectation, below, or above expectation. So you can kind of look, and again, unfortunately, the CPI, it consists of a lot of things other than commodities. Commodities are a very big part of it, especially crude oil. Remember, the wheat, corn, I'm going to get to in a second, those aren't part of the CPI. But you do have the finished products, cereal, loaves of bread, things that, they use wheat and corn and other items like that. So those prices ultimately make their way, rising commodity prices do make their way into food prices ultimately, but there can be and there usually is a lag. However, the ones that hit immediately they're in here too, and they're the biggest component, by the way, of these commodity-based indexes, the broad-based ones, are energy prices, particularly gasoline, crude oil, natural gas, heating oil, all that goes right in there. So you have the sharp spike here, and what I did, I boxed in, this is the month of September. So right now, and I haven't pulled what the expectations are, but we'll look at it at the time. You can see this is the beginning of the month here, so it doesn't take an expert, chartist to say, we're going to come in as of now. At least if you contribute the commodity part of the index, that's going to show that a pretty good tick up in inflation. Of course, that can be offset by housing data, which is the biggest component, the owner's equivalent rent. There's kind of a lag there on that, and either way. So you can see there's a month of clear abatement inflation. August was kind of slightly upward from where we started. Again, you just have to take a weighted average. They take the prices throughout the month. There was June was flat for commodities. May was a spike, up obviously. And so this is what I'm looking at. Look, we have today's the 23rd. So if we can continue on up here, the higher we go, that's going to at least catch the attention of some. All right, and if we abate back down, fall sharply by the end of the month, it's going to be almost a non-event. But I just wanted to point this out now. And plus, forget about Well, I mean, factor that in because again, that will be at some point a problem. It's going to. It certainly has the potential to alter the future trajectory of rate cuts. We know the Fed clearly said they've started, and it's not the first, or I'm sorry, it's not going to be the last. But whether they're going to do 50, I think Citi or somebody's now calling for another 50 basis point cut. Again, we'll see. I saw a headline today. But the more this does this over, in the coming months, the less the Fed can do this, right? Because this is inflation. And they will certainly take note of that. So, if this stays low, it gives them an all clear to bring rates to as low as they want. So we'll watch this. And more importantly, again, that's for the overall longer-term outlook of the equity markets, how that's going to play out. But I've listed these commodity ETFs as swing trade ideas. And so first and foremost, Powell's going to do what Powell does. We're going to make money trading on the charts based on technicals. So this was the last long entry here. I checked, and then that breakout. And so far, these commodity ETNs are doing good. DBA, I hit on earlier, that's the pure play if you only want to go in the ag arena. I'll cover crude and natural gas here in just a second. But, if you only want to go agricultural commodities, as I mentioned right now, I've been highlighting wheat, the grains recently quite a bit, soybeans, wheat, and corn. Those are your three big grains. But if you want to spread it out and you don't trade futures, they don't have, they used to have an ETN that held live cattle and lean hogs. That's gone now. So you can either trade the futures for feeder cattle, which are doing great lately. LE is a symbol, and you have lean hogs, live cattle. This just gives you a more diversified direct play on all the ag commodities. And you can see, look at this, doing very well. This is the return of inflation. This is what happens when the Fed pivots back to, again, it's going to be that vicious cycle. And the more this goes up, the more it's going to constrict the Fed's ability to continue to cut rates going forward, and the more pressure it's going to put on the market. Remember, Jamie Dimon himself, very wise man, we'll give him that. He said one of his biggest worries right now, more than World War III breaking out in the Middle East or anything else, is the risk of potential for stagflation in the going forward, and that's where you have flat to declining economic growth, recession, potential recession, or just weak economic growth with rising prices, commodity prices, inflationary forces. And it's very, very, very bad for the stock market and the economy. And so that's what you can get here. So we'll watch that. And again, that's longer term stuff. But day to day, we're going to trade off the charts. And the charts are saying right now commodities are doing good. We have our wheat based off targets on the 60-minute chart. Remember, if you guys, by the way, if you trade futures, you know this. If you don't trade futures, agricultural commodities have quirky prices. Some of these trade on, the London Exchange. They have different hours. Wheat will shuts down every day. I think it's like 2:30, something like that, p.m. So you're going to notice every day in the CTN, the prices go flat after a while. So if you're wondering why there's no more movement, it's because the futures that they're tracking stop trading and shut down. So I just want to mention that this is what it looks like here. So far, so good. Coming off that divergent low, we've got corn. I tweaked this downtrend line a little from where I had it last. It's the same downtrend line I've had. I just moved it up to today's levels. So you have intersecting downtrend line and 1819 resistance. Very nice level that if we pop that, it should be a quick run up to my next targets there. So still liking that one. And that's where soybeans hit T1 today. So that's off that divergent low. These are the targets I gave you recently. So far, so good. So looking good on the ETNs. On the ag commodities, of course, we're looking really good on natural gas. It broke out of that level. I been covering this one pretty extensively and frequently recently, highlighting this trading range. We've been bullish and long since back here. We hit our first, second, third targets right away, came back down, simply extended, made an equal and still bigger divergent low, have been highlighting this potential W basing or bottoming pattern and saying that it should really run and pretty much run hard if it breaks out. That's a powerful pattern. It's like energy building like a coiled spring. So it's no coincidence that today we broke out. As I talk, I'm sorry. I don't know what's going on here, but the futures, which I trade, NG, are up 8%, 7.97 right now. And so either way, we're pretty much effectively to that T5 zone already. So it's in 1 day an 8% scream because the futures have broken out, and still increases the odds we're going to go up to these deeper targets. So already, if those lows there, we're up about 27%. If we get to T8, that's going to be about a 70% run. And I think if I didn't think it was doable, they wouldn't be there. You'd see the word potential, and I've had T8 there. I'll add potential other targets if we start to get up there, and I think the charts are still constructive. And I've made that case quite a bit, especially a couple months back, based on the daily, the long-term charts. And again, it's look, do you think again this is mere coincidence? Starting to see, natural gas exploding higher and all this because again, Powell's gone back to his easy ways. So you can't have your cake and eat it too. He's pretty much, without saying it, declared victory on his war on inflation. Again, this is where I think you want to be right now. Stock market is insanely overvalued, very overvalued, and there's just these commodities are coming off nice big corrective waves, and this is either way. I like commodities. It's been made pretty clear lately. USO crude oil obviously doing good too. A little pullback today because on the daily chart here I just toggled to, we hit that. And remember I gave you this uptrend line here that was broken recently. We came down there. We traded it long there based on the futures recently. Rallied up here and now we back tested the trend line, and we're also just shy of the bottom of that yellow zone. A few months back I gave you these three zones, yellow, orange, and red, indicating the impact they would have on the stock market. And when we got in the orange zone there, both times I highlighted that and said stock market will get the memo soon. And both times, if you look at the charts, that was in April and that was in July. And because crude punched into my orange zone, even kissed the bottom of the red zone there. And so you can see the index that I trade. QQQ, what happened then? We had this one back in April. There it is. The biggest correction of the year by far, and it wasn't random coincidence. Crude prices got into the red zone or orange zone, and then they punched up again, and we had that 15.82, 16% drop. Again, set off by its own technicals, of course, but also coincided with those two punches there. So watch it. We're not even into the yellow zone yet, but so far the trend's there. If we start to move up again for the same reasons, it's going to put pressure on the U.S. economy because this one again has the most immediate impact. I don't have to tell you guys this. When crude jumps up, $10 a barrel. They're very quick at the gas stations to roll up the price of gasoline, unleaded gasoline for you. But when prices drop, they're not so fast to drop the prices. UGA is the unleaded gasoline ETF, you can see there. And so there's the trend line that it broke below. And if it can get back above that and this downtrend line, then that's going to be net bearish for the economy. Alrighty, I covered the grains. Yes, I did. All right, let's just roll into Treasury. A couple more things, we'll wrap up. TLT, like I said, we had the Federal Reserve do an unusual 50 basis point rate cut. Those are usually only seen in times of financial, market duress or some type of event, like a bank failure or something along those lines, some type of major credit risk to the markets. But we got that, and whereas most folks figured long-term Treasury bond rates would fall, which means prices would go up, the opposite happened, and so we shorted TLT there on the break of that trend line. We had a marginal new high. There's the that was right there was the peak was on Tuesday, the day before the Fed, And you can see, so the Fed meeting in nothing but selling sense, meaning, remember, these are bond prices. We're shorting bonds because this is a concurrent lift in rates. TYX is the yield on the 30-year Treasury bond. And so this is where we went long right here, right before they bottom. They've been moving up. And these are where I think they ultimately go to right there. All right. Either way, as far as a trade update, I always say that resistance or support, once broken becomes resistance. Remember, T1, our first price target was 99.20, which was hit. And look at what happened. So I haven't modified this line, went through, took it out. That support level, we gapped down below it, became resistance. Look how many attempts they tried to get up through there, and it failed so far. So I can tell you we're still in very close proximity. It's objective add-on. If you took a starter position, you're waiting to see some evidence, you can short it anywhere around up to that 99.20 level. If that pops, this is S1, which is now, I labeled it S1R1. It was support on the way down. It was support right here. Before I even gave you the trade, I gave you that first support level. I called it S1 because it was too low to be a target. I would figure we're not going to take profits on a little 1% or less drop. We bounced exactly where expected on the first support level on the initial tag. Then once we took it out, again, that line has not been modified. It wasn't just a random event. It was a huge red candle followed by a gap down. So that's what you want to see. And that further validated that my support level was correct as a significant level. The fact you had the big red candle through there and then a gap. Now, so where I'm going, if they take T1 back, that's now our first support level, resistance level overhead. It was former support, now it's resistance. And so if they rally up, any rally up to that level would also be an objective entry. I have it at 99.96. We'll call that 100. And then above that, if it goes above that, I would kind of sit tight. I wouldn't. You could stop out. You can stop wherever your entry price is. Everybody's different, but I would hold tight. And if it starts getting up much above that 173 level, there's a gap right there. That's where you might consider stopping out. That's also about where the entry point was on the trade, a little above it. Okay, and just to wrap the video up on, related note, I've been trying to do everything that was kind of tangential to each other, starting, roll it out of the small caps into the regional banks because of the high weighting there. Just the other day, last week, I gave you a few trade ideas that were all mortgage-related companies such as Rocket. And pretty much the opposite. Most folks thought we are going to see long-term bonds, the rates fall, and they've actually gone the other direction. And either way, these were based on their own technicals, of course, but we shorted Rocket here on the bearish engulfing candle. We hit my first target. And as expected, it's a reaction point upon the initial tag of each target. A reaction is to be expected. So it hasn't bounced enough. The only resistance is really back up here near the highs. And that would provide an objective entry. I don't want to see that happen really because you have the bearish engulfing. You can't violate it. That's the stop was set right above that bearish engulfing candle right here from the other day. But the next sell signal or objective entry will come on a break below T1. So really about, if you want to be safe, when you see the support there, I have it at 1849, but you look at the last reaction low right there below it, which is about 1833. That would be the level. When that goes, especially if it's on a daily closing basis below, it's going to increase the odds we're going to hit my next target or targets. T2, the trend line, T3 zone, T4 zone, and T5. So still looking good, but again, support is support until less broken. We hit our first target, so the trade's profitable. You could book quick profits. I don't want much. I forget where exactly it was on that day when I pointed out, maybe close to a 10% drop. Let me cover the other ones. That was Rocket. I did PFSI, PennyMac Financial. And I'm going to give you another trend line I just noticed here, right here, uptrend line that it's on right now. So the targets remain the same. T1 is this 105.63-ish price support plus the uptrend line, again, depending where it gets there. So, if it took a while to get there, it might hit them both at the same time, or it might slightly undercut the 105.63 and hit that bigger uptrend line right there I have. But here's a minor trend line. So a break of this will be your next objective short entry. Pretty much a break of today's lows. And then that trend line T2 is 93.52. T3 is a yellow uptrend line, which is the longer primary uptrend line. T4, T5. So all looking good, but again, they all just hit support and they're right above support. So they need to take out the recent lows. Then that would provide you the next objective short entry add-on. UWMC is in the same group. Another one, bearish engulfing candle, still zigzagging lower, plenty of room to go to buy first and all the other targets. So as of now, looking good. Coop was the other one. It's one of these. I think it was the Penny Mac I shared in the comment section below it. That post with these other three, but this one also you had that bearish engulfing candle here, and then it's like I said, so just updating, heading down to on the way to T1. When T1 breaks, the first target is the primary uptrend line. That's going to be a pretty nice sell signal and should open the door to T2. Also be the 200-day moving averages, and T3, T4, T5. So all right, guys, that is it. Yeah, that's all I wanted to cover now. If I see anything else, like I said, natural gas looking good. I'm just gonna, I hate to do this because then some people tend to put too much in that one because it's so volatile. You got to be careful. But what I wanted to tell you on that, and I say it all the time, I've been trading natural gas for years. I've been trading almost all these things for years. When she wants to run, she runs. I call her a trendy little sucker is the nickname I have for natural gas. There are periods of consolidation, and I learned to recognize those and then take the breakouts. But my point is, now there's no guarantee as how this thing's going to play out, but I've been harping on this W pattern, this basing pattern for a long time. We broke out today, and the nature of natural gas, when she wants to run, she can usually run. Likewise, on the downside, you don't underestimate. In other words, don't ever buy natural gas because it's oversold in a downtrend line. She'll burn you. She'll make oversold look like, it'll keep getting more oversold, deeper oversold, stay oversold for a while. Just recognize that when, during these trends, this thing can just go and go and go. And I've seen it go up sometimes 10, even 15. I've even seen 20% days in futures. And then it can do it again the next day. And then it can do it again the day after that. So the runs are pretty powerful. If my 8th target is hit, which the odds increase now that we broke out above the trading range, you still have 41% from those recent lows we're going long on. You've got it'll be a total of about a 70% gain on UNG, even better on the futures because UNG has some price slippage and all that. So all right, guys, that's your update. Let me wrap up here and get the video out to you, and if I see anything else, I'll let you know. But right now, let's just see how the market, this is still the first week after the Fed meeting. Markets are going to digest what happened. And so far, it's kind of, other than the pop on Thursday, it's just been really kind of wait and see for most folks. Markets just kind of consolidating since. This has been Randy Finney with Right Side of the Chart. Have a great day.